Why are some bond yields hitting 3-month highs? And should you wait until after the election to buy more treasuries? Hello, members, super savers, and bond course fans. I hope you're healthy and well. Here are the 3 topics that we'll be covering in today's update video. 1. Why do some medium and long bond yields keep surging? And should you stop buying treasuries like some institutional investors have? 2. Which treasuries hit 3-month highs? And 3. What are the expectations for the upcoming week's 2, 5, and 7-year T-note auctions? Plus, where can you find the best opportunities with new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. This week, the 10-year T-note hit its highest level since July, and the 20-year T-bond auctioned off at a high yield of 4.59%, the highest since May of this year. So let's talk about the 3 key drivers behind these surging yields. First, the Fed has stated that they will be more cautious about the pace of rate cuts going forward, meaning the likelihood of another jumbo rate cut has gone down. Second, recent economic data on consumer spending, job growth, and inflation indicate that the U.S. economy is still quite solid. As we've been saying since last year, Fed rate cuts on the short end do not necessarily translate directly to rate reductions on the long end, as long-term rates are ultimately set by the market. And slower, smaller Fed rate cuts at the short end, coupled with stable economic growth, a soft landing situation in the best case, which is where we appear to be headed at least for the moment. So, such a soft landing scenario could keep rates overall, and especially at the long end, at what I call elevated levels for longer than expected. And for the bond buyers in our community, this has had the effect of pushing rates and yields on the longer end higher in recent weeks, as the market digests all these data points. And the third driver for the continuing rise in long-term treasury yields, which we see everywhere we look at the moment, is election uncertainty. Election uncertainty has institutional investors concerned about the implications of the future direction of deficit spending and inflation, and consequently, bond yields and bond prices. And that's why institutional investors are selling off U.S. debt, or at least not buying U.S. debt as enthusiastically as before, and why yields have continued their upward trend. Because all else being equal, when demand for bonds is weak, bond prices go down and bond yields go up, bringing us to the question that I've gotten a lot recently from some of you in our community. Should you stop buying treasuries like some institutional investors have? And my answer in this case is, it depends. Something very important to keep in mind is that when institutional investors buy bonds, they generally do not buy them to hold them to maturity, unless there are specific circumstances, like in the case with defined maturity ETFs. Institutional investors typically buy bonds and they trade them. If you trade bonds, you don't really look at long-term yields to maturity. You look at current bond prices and how much you think they will go up or down, even in the short run. So, if you're a short-term investor or an active or even professional trader, then understandably, you may want to sit tight at the moment, like some of the institutional investors are doing until there is a bit more certainty after Election Day. On the other hand, if you plan on buying and holding to maturity, if maximizing coupon payments and or yield for the long haul is what's most important to you, which I know it is for many of our Diamond NestEgg regulars, then no, you should not stop buying treasuries. As I've said before, in my opinion, treasury yields are going through a good season right now if you look at coupons and long-term yields to maturity, especially on the longer dated bonds. And in the words of Warren Buffett, be fearful when others are greedy and greedy when others are fearful. So, if institutional investors and bond traders are fearful because there's so much uncertainty regarding the direction of Fed rate cuts, the economy, and the election, now may be your chance to be a little bit greedy about your long-term coupons and yields if you are a buy and hold bond investor. Use this good season for bond yields to continue dollar cost averaging into some of the bonds you like and build out a diversified fixed income portfolio. So, with that in mind, let's move on now to the next section of today's video. As we so often do at the end of the week, let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. Compared to the previous week, yields were up across nearly all maturities. The 3-year, 5-year, and 7-year saw the biggest gains, with yields rising between 18 and 19 basis points. And movements of this magnitude generally qualify as big news in bond land. In fact, the 2-year has not seen this level since August, and the other medium and longer dated maturities have not seen these levels since July. So that was the big news on the long end. On the shorter end, the 1-month and the 2-month were down slightly by a couple of basis points, and the 3-month was unchanged. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black and decreases in rates are shown in red. Treasury yields across all short and some medium maturities are still noticeably lower than they were at the start of the year, although the difference has narrowed quite a bit this past week for the 2-year and 3-year. The 5-year has even now joined the ranks of the longer dated Treasuries, with yields that are above where they were on January 2nd of this year. And overall, with short end yields down and long end yields up versus the beginning of the year, the yield curve continues to steepen. The widely used comparison of the 2-year versus the 10-year Treasury has been in positive territory for a bit now. And while the extreme comparison of the 1-month versus the 30-year still shows inverted yields, meaning that the 1-month is paying a bit more than the 30-year, the difference has shrunk to 38 basis points from 147 basis points at the beginning of the year. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker or when you sell will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. The 52-week T-bill is also on the calendar. And if we scroll down further, we can see the 2-year, 5-year, and 7-year T-notes will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupon is still to be determined. Also on the schedule is this 2-year floating rate note, which is also not a reopening auction. At the time of this taping, here's what the expected yield is for the 52-week T-bill on Fidelity's platform. And here's what the coupon and the expected yield are for the 2-year T-note. Here's what the coupon and the expected yield are for the 5-year T-note. And here's what the coupon and the expected yield are for the 7-year T-note. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one at 5.78% from FHLB, with a first call date 9 months out from the time of this taping. One of our Diamond NestEgg regulars, Darcy, emailed me about another FHLB bond with a slightly lower yield at 5.6%. But a first call date 1 year out. So if you are looking at these new issue agency bonds and or corporate bonds, which we'll be getting to shortly, do check the first call date on them. And keep in mind that the higher the yield and the further out the call date, the quicker these bonds are sold out, understandably, as quite a few of our members and bond course folks can attest to. Moving on now to corporate bonds. Here's where the highest yielding new issues stand at the moment. And once again, there is a fairly long list to choose from, with the highest yielding one at 5.75%, again from Deutsche Bank, with a first call date about 2 years out from the time of this taping. If you're interested in brokered CDs, here's where the new issues are currently, with the highest yielding one at 4.5% from the State Bank of India. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still attractive, then check out this video here on our 2024 bond courses. Or come join our next live member Q&A happening this weekend on Sunday, October 27th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be diving deeper into the community's top of mind questions. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. See you again very soon with more brand new wealth building content for your financial journey.